Hello and welcome to a brand new episode of Market Sense powered by ETMarkets. Well, it is a show which talks about market trends, economy, sectors, investment strategies, as well as some candid conversations as well. Well, my name is Kshitij Anand, and today we have with us a very special guest, Rupen Rajguru, who's Head of Equity Investments and Strategy at Julius Baer India. Well, Rupen has more than 2 decades of experience in Indian capital market, and prior to this, he was with HDFC Bank as well as Citibank. Well, welcome to the show, Rupen.
Thank you. Thank you very much, Kshitij. Pleasure to be here.
Any sector which you are currently overweight on? Why?
Now we are entering into an era of the earnings growth, which will be higher than the nominal GDP growth.
Sure.
And also, what lacked in last 10 years was the overall capex cycle. So the capex cycle, we believe we have already entered into a phase in which there would be a strong capex cycle. The government cycle has been strong, while there are bits of ups and downs in that. But the private sector and the household sector capex, which was lacking in the last 10 years, I think there we are clearly seeing visible signs.
Right.
And real estate, which is the largest segment as far as the household capex is concerned, so there we are seeing revival. Now, for last almost 5 to 6 quarters, the real estate cycle has been pretty strong in India across various geographies. And the corporate capex cycle, typically after 7-8 quarters lag of real estate cycle, also do tend to pick up.
Okay.
So there we are seeing recovery. So to play this entire theme, we are positive on the financials because it's a most leveraged play on the economic growth. And also we are positive on the financial services, companies from the insurance sectors, which actually have been a big underperformers, but we believe the long-term growth trajectory is intact, and they have got hit because of COVID-related crisis and higher reinsurance cost. But I think that will normalize, and we believe that's a good sector to be into. And as I said, since we are positive on the overall revival of capex cycle, so some of the companies which are associated with industrials, capital goods, consumables, even cement, real estate ancillaries. So these are the sectors which are again linked and to the overall cycle. Those are the sectors in which we are positive.
Right. So capex cycle will actually turn out to be a big theme for at least FY23 and 24. So financials in terms of sectors, financial services, as well as real estate. Any sector which you're underweight on, you think that some analysts are quoting autos could be in trouble because of what is happening with respect to semiconductors, as well as there is other shortages related to Russia and Ukraine. What are your views on that?
So, before I get into underweight sector, autos you mentioned, and in fact, it's a contrary a buy sector or overweight sector for us.
Okay.
The reason for that, Kshitij, is pretty simple. So this is the sector, in fact, auto industry had their peak sales in 2019, barring tractors. And right now, in 2022, at an industry level, we are still 20-30% lower volumes than what we had seen in 2019.
Okay.
So while this industry has already been seeing a slowdown, then there are reasons. Earlier there was higher emission norms related costs, insurance costs, and there were certain issues around that. And then we got hit by COVID, which also impacted the volumes, and also the semiconductor issues. This is what we just alluded to. But net, we have seen a very rough cycle for the industry players for last 4 years. And in fact, we believe there will be a cyclical upturn in that industry. And hence, again, not a long-term 5-year theme, but as an immediate next 1-2-year theme, we believe autos as a sector will actually do well. And we have a tactical overweight positions on as far as autos are concerned. Coming to your question on underweight, I think the sectors which we are underweight are those sectors which typically in a high interest rate environment, the companies which have higher PE will underperform. So a lot of the companies, say from a consumer staple sectors whose valuations are very high as compared to the growth, and plus there will be challenges on margin side because of higher input costs. So that sector has underperformed, and we continue to maintain our underweight stance there. And some of the other sectors which have got significantly re-rated. So one of them is mid-cap ITs, which we just spoke about. So that sector from say sub 10 P has gone up to say 35, 40, 50 P. So while large cap IT we are neutral, but mid-cap ITs we are underweight at this juncture, because the risk reward we believe is clearly not in favor. So these are typically we'll want to avoid those sectors where there's a big mismatch between valuation and the growth which they are exhibiting.
So small and mid cap stocks, some of the small and mid cap stock, could you or a high beta stock, do you think that these stocks could be under some way of pressure as we move towards a higher interest rate environment? Because somewhere down the line, public sector banks have already communicated a higher regime in the coming few quarters, and RBI it's only some time away where RBI will increase the rates.
Interesting question. And Kshitij, if you were to look through the last 20-year history and plot of a mid cap or a small cap index, it has outperformed, say, a Nifty, but the bouts of volatility are pretty high, right? And so the drawdowns are pretty steep as compared to drawdowns which we see in large caps.
Right.
But also, if you track it, you're right that in a rising interest rate scenarios, they do tend to underperform, but their performance is very strongly linked with also the overall liquidity scenario. Right. So whenever the liquidity in the system is high and low, that also impacts the performance of mid and small caps. So from that perspective, as we are entering globally as well as in India, a regime of interest rates which are higher. Thankfully, Indian economy was not overstimulated as much as US, and hence we will not that unwinding which we are seeing in US, that kind of unwinding we might not see it in India. But in that period, the mid and small caps do underperform. But having said that, Kshitij, in India, a lot of if the economic growth is what we are seeing, that will continue,
right,
or the growth will accelerate from where we are. A lot of these mid cap, small caps companies will become much bigger than what they are right now. Like just example, say in 2016-17, the entire chemical industry, chemical sector was a small cap, right? Nobody knew about that sector. The entire market cap was
specialty
small.
chemical,
and now specialty chemicals.
Yes.
And now we have companies with 50, 60,000, 70,000 crore market cap in those sectors as well, right? So there will always be historically bottom-up opportunities available in mid and small cap stocks. So as a pack, it might probably underperform for next 1 year, till that valuation readjustment happens. But within the sector's bottom-up opportunities will always be there, and there will always be a 5-bagger, 10-bagger coming out of mid cap, small cap, irrespective of if that index underperforms the last.
Sure. Well, thank you, Rupen, for your insight on market, and that's all for now. But do stay logged on to ETMarkets for more on news, business, and economy. Again, thank you so much for your time, sir. It was an interesting conversation.